Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Minister Mark Carney has signed a partnership with Japan to expand energy, trade, and military cooperation. The agreement outlines a pledge to increase the flow of liquefied natural gas and liquefied petroleum gas to Japan and collaborate on nuclear and clean energy projects. Both countries also promised actions against illegal fishing, joint Navy training exercises, and close cooperation on cybersecurity to strengthen defense and security. Shares in Algonquin Power are taking a hit. Look at that, down more than 12%. Profit and revenue beating estimates in its latest quarter, but analysts are focusing on its profits outlook. Algonquin cut its 2027 profit forecast due to a higher than expected tax rate. Algonquin says it will look to mitigate the impact through additional efficiencies, but analysts are raising concerns on whether it will carry over into 2028. Shares of Martin Ray International are under pressure. That's after the auto parts manufacturer missed on revenue expectations in its most recent quarter. Sales outside of North America and Europe also fell 17% compared to the same period the year before. Now, on the upside, the company posted profit that beat estimates and saw sales rise in North America and Europe. And taking a look at the markets, it is another off day. The TSX down by nearly a full percentage point again. And south of the border, some soft employment numbers having an impact down there, along with everything, of course, that is unfolding in Iran. Fuel oil prices are soaring, and you can see the S&P 500 off by nearly a point, the Dow around the same, and the NASDAQ off by about 0.8. Well, oil prices have surged by about 20% this week, the biggest jump since 2022 due to the war in the Middle East. Here to talk about this and today's markets is Art Hogan, Chief Market Strategist of B. Riley Wealth. Art, thanks as always for joining us.
Thanks so much for having me, Roger.
It's been a bit of a roller coaster for the oil prices. They shot up, no real surprise, and they kind of stabilized for a second. Then they were stabilizing again yesterday, and now they're back at it.
Yeah, I would tell you the market's reaction, especially in the commodities markets, really is day to day, and it's dependent on two things. A, duration of this conflict. Clearly, when this started, I think markets had an anticipation this may be days to a couple of weeks. And right now, the White House is talking about a longer duration, and we're hearing about more destruction of supply. So in the region where a great deal of supply comes from, we're already talking, you're hearing Qatar, who produces about 20 or 25% of the world's LNG, is down for at least 2 weeks and probably a month. So that is obviously putting pressure on hydrocarbons. But clearly, getting any product through the Strait of Hormuz still seems to be impossible. Now, the administration has tried to do a couple of things, but that's going to take a few days before that happens. So about 20% of the global oil supply comes through the Strait of Hormuz, and it's really shut down. There's no traffic through there virtually at all, and that's not easily replaced from other parts of the global supply chain. So that's why we're seeing this spike in energy prices. And the problem with a spike in energy prices is it's coming from demand destruction. I mean, from supply destruction, and not from an increase in demand. There would be an economic benefit if we had a surging global GDP growth that was demanding more energy product, bringing the prices up. But this has negative implications to it, and I think that's exactly why markets are reacting the way they are. It's real bad news. Cuts two ways, increases inflation, and takes away consumer discretionary spending. So this has not been a pretty picture this week, and a massive move in energy prices in a very short period of time.
Now, if this does look to drag on, would companies be willing to take the chance to try and get the oil through that strait, or are they just going to lock it down and not move?
Yeah, it's interesting. So companies, meaning the shippers, don't have a choice because they have to do what their insurance companies tell them to do. So if your insurance company says you are not covered if you go through the Strait of Hormuz, you drop your anchor and you wait to hear until you are covered. That's one of the steps that the administration was talking about. backstopping the insurance companies to allow flow to go through the strait. And clearly that hasn't happened yet, but that's one way of trying to get in front of this. And obviously the other way would be to have the Navy sort of work on a basis of protecting ships as they travel through the strait. It's only 21 miles wide. So, I mean, clearly both of those things could happen, just haven't happened yet. So with that lack of any new supply coming into markets, it's a very difficult process to not see energy prices continue to go up.
And is there anywhere else in the world that could pick up the slack this quickly or no?
Unfortunately not. There's not a lot of excess supply coming from other parts of the oil-producing countries around the world. Now, Russia can pick up a little bit of this, and what they're not shipping to India, they will likely ship to China now because all of Iranian production was going to China, and that's the biggest loser in this process. The good news is North America is more or less energy independent, but that doesn't help on the global market. It certainly doesn't help in the overall pricing of both WTI and Brent. But yeah, there's not a lot of spare capacity that can be brought on very quickly. I know the administration said something about Venezuela, which is a rounding error in what they're producing right now. So clearly, we need the product that comes through that strait, and it's not coming through right now.
Okay, and the other big news, of course, today, the jobs report, 92,000 jobs lost in February, and we weren't expecting that, were they?
No, it was interesting. Two things. So the estimate was for something positive, call it 60 to 70,000 jobs. So that was a big miss. We had an ADP number, which is a private company that brings out a jobs number earlier in the week, and that surprised to the upside. So I think anticipation was even higher for a better number coming in, and it was much worse than expected. So if you look at this on a 3-month average basis, we're creating 6,000 jobs a month, and on a 6-month average basis, we're losing 1,000 jobs a month. That compares to a year ago when we were creating 150,000 jobs a month. Now, the problem is we don't know how many jobs in this economy with no immigration and aging baby boomers we need to create on a monthly basis. What we do know is it's not what we're producing right now. So unemployment went up. It's 4.4% up from 4.3%. While that doesn't sound alarming, directionally it's concerning, especially if you look at the average jobs production that we've seen over the course of the last 6 months.
And what does all this mean for inflation and the Fed for any? Now we're hearing talk now of a possible rate hike.
Yeah, so it's interesting. The Fed's got two mandates. So the Federal Reserve looks at two things equally, and one is full employment, and the other is inflation. And both of those are heading in the wrong direction. So to think about that is it just basically means they're in competition with each other. We have a weak labor market. That continues to be the case. That would actually make the argument for cutting rates. But this inflation continues to pick up, and energy prices aren't going to help that. But we've also seen inflationary inputs from our PPI, our prices paid, and our ISM manufacturing. So across the board, these dueling mandates are actually in a duel right now. And I think that's why the consensus for the Fed is they're probably going to keep rates where they are, at least until June, and see if any of this kind of settles out a bit before they make a decision. But, I would say that the next move that they make will likely to be to cut, but it's not going to be anytime soon. Probably wait until the fall before a lot of this sort of works its way through the system. All right,
and there's so much to unpack before then. In the next couple of weeks, I think a lot of things hopefully will be decided, but until we do see some kind of a decision, what are you thinking the markets are going to be doing? Are we going to see more of this going into the red and dropping?
Well, I tell you this, right now, markets are very much using energy prices as the barometer for risk, right? So if you come in any morning and see the price per barrel of oil has gone up, markets are going to come down. We've seen this correlation before in times of turmoil like this. So that's the environment we're in right now. While we're doing that, we're creating some incredibly low multiples, especially for things like technology, which was under fire before this even began. So at some point in time, we'll come in, some supply will be coming through the Strait of Hormuz, energy prices will start coming down and probably retrace half of that upward move, and markets will likely be bought. We're just not there yet, but I think it wouldn't take much of a tipping point in energy prices with product flowing through and actually getting delivered to see markets look at how much damage has been done, and start sort of dipping their toes into things like technology, which really is agnostic to higher energy prices. Of all the 11 sectors in the S&P 500, they're probably the least impacted by high energy prices. Okay, we have to wrap it up there, Art, but thanks as always for joining us. Have a great weekend. Thank you. Art Hogan is Chief Market Strategist at B. Riley Wealth.
Coming up, a new Desjardins report examines where food prices may be heading this year. Our next guest will help break it down. A new report from Desjardins is taking a closer look at whether Canadians can expect any meaningful relief from food inflation in 2026. To help us unpack the findings and what they could mean for consumers, we're joined now by the report's author, LJ Valencia, an economist with Desjardins. LJ, thanks very much for joining us.
Pleasure to be with you today.
Overall, what are we looking at for when it comes to food and inflation? What are we looking at for the next year?
So I suppose in the near term, we do anticipate food inflation to remain elevated relative to pre-pandemic norms. And so the main driver we believe for 2026 will be the prices of food purchased from stores. That said, we do expect to see some outsized contribution from the prices of food purchased from restaurants, which will be slower but still sustained. And part of this is really motivated by base year effects stemming from the GST HST holiday from at least a year ago. And that said, we do expect price growth to likely stabilize as factors such as input costs and wage growth gradually normalize.
And now, just going back for a second, you said since the pandemic, what has been driving the cost of food? What has been driving it up? This has been going on since the pandemic, you're saying?
Well, since after the end of the pandemic. And so there's a myriad of factors that sort of put this overlapping pressures on food prices after the end of the pandemic, such as supply chain disruptions. There's been growing input costs. And last but definitely not the least, extreme weather events due to climate change, which have been affecting the food supply stability that we've used to expect before the pandemic.
How bad has that been getting? Do you have any stats on that? Have we seen more extreme weather incidents?
Well, there have been studies that suggest that, extreme weather events have been rendering global agricultural supplies unstable, as we've cited in our report. And so there's definitely evidence that points to that. That said, we don't necessarily have a full quantitative factor, but we do expect extreme weather events to be an upside risk to price growth, especially if, say, for example, there's, droughts in the summer that will cause, domestic and international food supplies to decline. And we have seen this happen in the past, say, for example, back in 2021, when extreme droughts have affected domestic agricultural supplies.
Okay, and then now looking ahead for 2026 again, let's just break it down a little more. First half, we're still going to see pressures. Where will they be coming from? And any indicators on how much pressure?
Well, at the moment, it's kind of roughly balanced, but in the near term, we do expect food purchase from restaurants to drive much of the food prices moving forward. But still, for much of 2026, food purchase from stores will make up a much more outsized contribution to food CPI. Now, if we look at this in the context of the overall headline CPI, we do expect a contribution of roughly 0.5 percentage points in 2026 and 0.4 percentage points in 2027 for food inflation in general.
And is this the fuel costs that are driving this, seed costs, wages?
Well, there's a myriad of factors that influence, our current outlook. I think a lot of it comes down to the fact that we are a small open economy. And so we don't really have a lot of say or influence in the prices of goods that we import into the country. And so, for example, that leaves us vulnerable to, say, for example, the depreciation in the Canadian dollar. While that may be good for imports, that has partially contributed to rising import costs.
And are there sectors harder hit than others?
Well, that's a little bit more difficult to say, but I think what's really important to emphasize is that, for example, households have been struggling with dealing with food inflation. Say with the latest data that we've had from StatCan, roughly 1 in 5 households have been facing moderate or severe food insecurity. So I think it's really important to also put that into context.
And so are people, so when I asked about the sectors, I meant like dairy or or a farm or meat, things like that, are they being harder hit than other groups, or is it across the board for the different sectors within the industry?
I think it really depends on, say, for example, the sort of price pressures that these particular sectors face. But for example, for sectors that heavily rely on like fresh food imports and inputs, that's really what's critical and vulnerable, I suppose, when it comes to facing price pressure, so to speak.
And with the consumer that you were just talking about, are they changing their spending habits? Are they foregoing things or shopping in a different way or changing stores or anything like that?
Yeah, that's a really good question, and thank you for raising that. Now, there seems to be some evidence that suggests that a lot of Canadian households are adapting and changing their spending habits. There was a recent Bank of Canada research report that looked into this, and the evidence that they found seems to suggest that's to be the case.
Okay, LJ, we have to wrap it up there, but thank you very much for joining us.
Thank you again for having me.
LJ Valencia is an economist at Desjardins. Coming up, we'll discuss how the conflict in the Middle East is unfolding and how it is drastically impacting the price of oil. As the war in the Middle East widens and lengthens, the U.S. and Israel hit deeper into Iran. U.S. President Donald Trump adding he must be involved in picking Iran's new leader. And Canadians in the region are hearing about a way out. CTV's Adrian Goberl has more.
The screams of young children can be heard as one of two Iranian drones slams into the ground near a school. A second hitting this airport terminal. Azerbaijan's president has vowed to crush Iran with an iron fist after he says 4 drones were fired into his country. Iran has denied any connection to the attacks, instead blaming Israel.
Iran is exporting the war, trying to expand it to as many countries as they can to sow chaos.
In Tehran, an ever-intensifying onslaught from above rocked the city for a 6th straight day, where more than 1,000 people are now said to be dead. In parts of Beirut, concrete carnage where neighborhoods once stood. Traffic jams now line the streets with panicked civilians after the Israeli military ordered the evacuation of hundreds of thousands from the southern suburbs of Lebanon's capital city.
Antidrone, antimissilistica.
This all comes as confirmation from Rome today that Italy is sending air defense systems to the Gulf. Spain also announcing it's sending its Christopher Columbus frigate to Cyprus to join a French aircraft carrier and Greek naval ships. Great Britain now has 4 fighter jets en route to Qatar. With each passing day, more NATO members are being drawn in.
It's affecting us. It's affecting the entire globe. This is a global conflict.
CTV News is currently stationed near the Incirlik Air Force Base in the southern Turkish city of Adana, along the eastern Mediterranean, where Turkish and U.S. NATO air forces have been stationed for decades. Just yesterday off the coast of the NATO base, an Iranian ballistic missile was shot out of the sky by NATO forces as it entered Turkish airspace. While Iran has denied targeting Turkey, one former NATO commander says he has little doubt about the aim of that Iranian missile.
They're going after that airbase by design. Ballistic missiles are aimed. They know what the flight path is. These Shahed drones are aimed. They know what the flight paths are. This does not happen by mistake.
And make no mistake, this is now a conflict forcing the hand of several NATO nations across the globe. The multiple drone strikes on Azerbaijan makes this the 12th country to accuse Iran of firing deadly warheads in their direction since this war began. Adrian Goberl, CTV News, Adana, Turkey.
And the war, of course, wreaking havoc with the energy markets. Oil is headed for its biggest weekly surge since 2022, shipping through the Strait of Hormuz at a near total standstill. For more on this, we were joined earlier by Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James.
We've seen that oil volatility really pick up, and these tensions with Iran have risen. So shipping through the Strait of Hormuz, has reportedly fallen 70 to 80%. And that's really tightening the global supply expectations. And that's because roughly 20% of global oil flows through that corridor. So prices have been reacting quickly. We saw Brent move back above that 80, energy stocks followed, and even the energy sector ETF is up about 24-25% year to date. And that's really where we see Canada becoming an interesting opportunity from an investing standpoint. When geopolitical risk rises, buyers really prioritize stable and reliable suppliers, and Canada stands out in that front. So the resource base is huge in Canada. We hold about 170 billion barrels of proven reserves, and mostly long life oil sands that can produce steady for decades. So the economics also work at these prices. Many oil sands project break even around that $40 to $50 per barrel. So near $80 generates strong free cash flow. And that cash is increasingly returned to investors through dividends and share buybacks, really showing much more disciplined sector than we've seen maybe in past cycles. So even though most Canadian oil goes to the US, we are seeing demand that is remaining strong because many US refineries are designed for heavy crude when Canadian producers' supply is consistent.
Now, I mean, they love the stability of Canada, but I guess the question they're looking at is, how long is this going to last? We heard comments recently, just this morning, from U.S. officials saying this could be over in a few weeks. And then we had the Qatar energy minister saying, hey, if we have to shut down production, we'll see $150 a barrel. But I guess, are investors ready to just jump into Canada, or do they want to wait a little bit and see what happens in the Gulf first?
Yeah, before any of all of this geopolitical risk kind of happened, we did see the energy sector extremely undervalued in Q4. I started saying we were more bullish on energy, just looking for value in the markets of where you could see potential price appreciation when the markets was a little bit stretched. So, yes, this has helped pop a lot of those energy stocks as well. But as you mentioned, is this going to be short term? Can this be a tactical trade that people can, participate on the upside, take some profits off the table, and then continue to diversify their portfolio through 2026, as we do expect additional volatility to continue. But, the chances, I think I've read a few times, it's about, 50-58% that, that this happens until September. But it could be, weeks, as you mentioned. So right now, no one has a crystal ball. No one really knows how long this is going to go. I think it's being active and dynamic and being able to pivot if you need to, if the changing dynamics do change. But I do think, Canadian energy has participated, and there are some still great Canadian stocks that we think are good opportunities to be participating in for this rally.
All right, we're going to be talking about a few of those coming up. But also in this is the Canadian dollar. The U.S. dollar is strengthened on everything that's unfolding with the energy, but the Canadian dollar as well with the energy. Is that good, bad? What are your thoughts on that?
Yeah, we see this again. I think it's a little bit more of a short-term blip. With the rally that we are seeing and some of the uncertainty. I mean, a lot of people, even the retraction of the U.S. dollar we saw last year off the peaks and even through this year to start the year. But now we're starting to see, as you mentioned, this short-term rally in both the Canadian and U.S. dollar. And I do think that is a little bit more on this fleet of safety too, right? Like safe currencies, and, you're seeing the same thing with gold and safer asset classes. And both Canadians and U.S. and globally, I mean, the U.S. dollar is still one of the largest, strongest currencies. So even though we saw, a pullback last year off the peak, the U.S. dollar down about 9%, we still think that they are safe currencies globally. And this is more of a short-term play on that currency side.
And that was Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James. Coming up, shares of Aecon Group are rising higher today. We'll tell you why after the break. Prime Minister Mark Carney and Japanese Prime Minister Sanae Takaichi signed a comprehensive strategic partnership aimed at deepening cooperation in defense, energy, and technology. Canada is looking to expand LNG and other energy exports to Japan and strengthen defense in the North Pacific and Arctic. Japanese officials have also stressed that continued investment in Canada's auto sector depends on a successful review of the Canada-US-Mexico trade agreement. The U.S. economy saw a decline in jobs last month after a strong start to the year. According to data from the Bureau of Labor Statistics, 92,000 positions were lost in February. Economists were expecting a gain of 55,000. Meanwhile, the unemployment rate climbed to 4.4%. The decline in jobs partly reflected a decrease in healthcare employment due to strike activity. Shares of The Gap are tanking, off 13%. The clothing retailer reported fourth quarter sales and profit that came in below expectations as two of its apparel chains underperformed. Old Navy and Athleta, which are the company's largest and smallest brands, respectively, missed same-store sales estimates. On the upside, Gap and Banana Republic beat expectations, and the company is forecasting better than expected profit for the year. And taking a look at the markets, it's getting even worse right now for the TSX. It is now off more than a point, 1.13%, and pretty much every sector is in the red today. Not a good day south of the border. It's not much better. Everything there also in the red and off by pretty much close to a point or worse. S&P 500 down by 1.06. The Dow by nearly 1.2. There you go, 1.2. And the NASDAQ by 0.9. Aecon Group beat analyst expectations with stronger profit and revenue. Here to break down the company's latest report is Maxim Sichev, Managing Director of Research and Industrial Products at National Bank Financial. Maxim, thank you as always for joining us.
My pleasure.
A good report.
Yeah, absolutely. Backlog is up 60% year on year, and revenue was better than expectations by 11%, EBITDA by 45%. So, these are good numbers. And as you were talking previously about the very weak tape, it's very nice to see that Aecon shares are bucking the trend and are up 10% on the day. So definitely a very strong print overall.
Where were they strongest and where were some areas of concern for you?
Yeah, so, the whole dynamic is obviously around expectations. So I think the market was imputing potentially some of the legacy projects hitting the bottom line, which did not transpire. So that removed a question of uncertainty when it comes to profitability. And the other dynamic is just the sheer amount of revenue growth really driven by nuclear, utilities, and civil work. So it's really a combination of strong top line without any kind of negative surprises. That's really what led to much better performance.
And some of those projects, is that like the Eglinton Crosstown in Toronto? What else?
Correct. Yeah, so Eglinton, as everybody in Toronto knows, that one is operational. Finch LRT is up and running as well. And so the only legacy project which is remaining, it's Gordie Howe Bridge. And there, substantial completion on construction is going to take place kind of between now and the first half of 2026. So we're getting very close to mopping up all kind of the legacy issues. But critically, when you look forward, from a composition perspective, nuclear right now, it's 30% of top line, and we strongly believe it's going to grow materially more on a prospective basis. Utilities is a very strong business for the company, both in Canada and in the U.S. As you might recall, the company has a JV partnership with Oak Tree, and they've been growing this business fairly aggressively and profitably. We haven't even started talking about nation-building projects in Canada. Defense. Transit work is still very robust. So I got to be honest. This is the strongest Aecon setup from an investment thesis perspective. And I've been covering the name for many years. That I have seen relative to its own history. So the stock is obviously reflecting these positive dynamics, but certainly deservingly so.
And I just want to go back for 1 second on the legacy with the Eglinton, because we obsess about it here in Toronto, but they're also involved in the extension of it. Any concern, or they are involved in it, any concerns about that right now? Are they handling that one? Are things going smoother than the first half of that project?
Yeah, to be honest, the contract structure for the recent batch of projects has been changed. So relative to kind of P3 fixed price envelopes that were proposed by the governments in the past, right now it's around target margins where it's highly unlikely that the company would end up in a very similar situation. So I think there is less confrontational relationships, number one. And number two, we're also over the hump post-COVID, where it was very difficult to get employees, materials, supplies, et cetera. So right now, the entire supply chain has just basically normalized, and we expect this to remain so on a prospective basis.
And with your optimism with nuclear and utilities, I imagine a lot of that is data centers.
Yes, so that's data centers is more of a U.S. play. In Canada, it's the legacy of population growth, which has we experienced over the last decade. And if you look right now, Ontario is trying to build potentially 10,000 megawatt capacity on a prospective basis in nuclear. And what makes the Aecon thesis so interesting is that the company is completely agnostic when it comes to technology selection. So right now, Aecon is doing all of the refurbishment work at Darlington and Bruce. And so let's say that CANDO is going to be the go-to technology, which we strongly believe that's going to be the case. But nevertheless, they're going to be able to do CANDO-related work, as they're doing right now. They are the only construction company right now building an SMR technology in Ontario as well for GE Hitachi, and they're also doing some work on SMRs in the US. So as long as nuclear basically is going ahead, Aecon is going to get a piece of that, and so that's what makes the thesis so attractive. And as I mentioned, right now nuclear is 30%, and honestly, I would not be surprised if it drifts to potentially 40% over the next kind of 5 to 7 years. So the upside is still very, very material from our perspective.
And with what's unfolding in the Middle East, any concerns there? Do they have any connections or any worries about that?
No, thankfully, no exposure from that perspective. So it's very much of Canada / US story, and just also from a positioning perspective, when we chatted last time, there is concerns around the engineering space and how potentially the business model could be disrupted by AI. Construction is being perceived as a safe industry to own, and so not only do you get better execution momentum right now, you also have a huge revenue visibility, but also the fund flow dynamic is helping the valuation parameters. I mean, that's why the multiple has expanded for Aecon. But what's interesting is that relative to US peers, it's still trading between kind of 40 to 50% discount versus the likes of Quanta, Mastech, Primoris, et cetera. So again, we strongly believe there is materially more momentum for Aecon shares on a prospective basis.
All right, and you have it at outperforming. I just looked at a number. It's at its highest level since 1991.
Yeah, and we strongly believe it's going higher. Absolutely.
Okay, we'll wrap it up there. Maxime, thank you as always for joining us.
My pleasure. Take care.
Maxime Sichev is Managing Director of Research in Industrial Products at National Bank Financial. Coming up, we'll hear from the CEO of AGT Foods on the company's decision to return to the public markets after going private in 2019. AGT Foods listed on the TSX this week, launching a $450 million IPO on Monday. Now, that was the same day as the TSX dropped like a stone. For more on this, we were joined earlier by Murad Al-Khatib, CEO of AGT Foods.
Obviously, it's a decision we don't do for one day or 1 week of trading. You roll with the punches and you focus on the fundamentals of your company and deliver.
You mentioned that it is a process that takes a long time. Could you have held off if you wanted to?
Yeah, you get to a point where you've got to make a decision, right? And the week before the listing was finalized, we hadn't had a war starting yet. So anyway, the decision was made, and again, no regrets. We wanted to take the company public again, get back into the public markets. Fairfax and management founders decided that the time was right, and we're going to focus on executing free cash flow and growth. And protein and dietary fiber is a fundamental in the market, and we're very excited about the future.
You mentioned the conflict, which of course began on the weekend. Does it affect your business operations at all?
Well, we certainly have a very large business in the Middle East region. Of course, lentils, chickpeas, peas, beans are staple consumption items. And, we're very active, actually, with the United Nations agencies on the Gaza refugee program and other things. So, certainly, we're watching the conflict very carefully. But, unfortunately, for the world, we're going through this conflict. And, upon resolution, food is going to be a very important part of the resolution. So, again, our factory operations in Turkey are fully running with no effect. Obviously the Mediterranean region is sitting, in a very different position. So we're waiting for the resolution, and, our assets and our supply chain is going to be ready to be shipping what we believe is going to be large volumes of food needed to stabilize the region.
So are your shipments halted at a certain point right now? Have they been halted since the weekend?
Yeah, everyone in the world, it's not AGT specific, steamship lines and container ships are obviously, halting shipments around the world. We were very fortunate, actually, that we had a large volume of cargo that arrived into the United Arab Emirates just recently, just prior to the shipping line stopping. The balance of our cargo mostly is already at transshipment points, just more in Panama Canal or in Europe. So we have a very integrated supply chain, Marilla. We're going to be able to take that to other clients that are looking for cargo, and then we'll reship when the conflict is resolved. So
I was going to say, how long before this problem in the Middle East becomes more of a problem for your bottom line?
We're diversified. We're shipping to 127 countries around the world. And, the Middle East is one, important region. But, this is pretty, in terms of stopping shipments, it's pretty localized into the Persian Gulf region. So, we do have notifications now that a number of the ports in Saudi Arabia are open. We have, ports even on the other edge of the United Arab Emirates, that are still open. Fujairah, for instance, is open. Jebel Ali is not. So, we don't, anticipate that, this conflict, number one, we hope it won't have the duration, but number two, we don't see a material effect on our business going forward.
You've got some workarounds. Okay, let's talk about 2025 revenue, which came in at $815 or $830 million. That's the estimate, I understand, down from over $1 billion in 2024. So what led to that drop?
Again, just we divested a business to get ready to go public. We actually sold a bulk handling business. We're really focusing on the packaged foods and ingredients, the better for you, gluten-free, high protein, high fiber, breakfast cereals, bakery and snacks markets, gluten-free pasta in the US, and pasta manufacturing around the world. And so when we divested some businesses and commodity prices came down, it leads to a lower revenue, but very consistent EBITDA. And, we see consistent growth going forward in both revenue, EBITDA, and free cash flow. So from that perspective, the business has really transformed from when we were public before. This is a packaged foods business now. When we were public, we were 18 million of EBITDA on the packaged foods. Today, we're 92 million and growing. And, that packaged foods business, the health and wellness trend is not a fad. Protein and dietary fiber are fundamental. Demographics are driving it. GLP-1 drugs are driving the need for dietary fiber and protein. And I call it the earthquake in the food industry. It's coming quick, and food companies have to react or they're going to be destructed by consumer demand. So from that perspective, lentils, chickpeas, peas, beans are important protein and fiber crops for the world.
Okay, so you took the company private only in 2019, so 7 years ago, and you went public again this week. What led to a decision to go back into the market?
Well, great partner in Fairfax. Fairfax owned 59.6% of the shares. They continue to own, call it 56% of our shares. So Prem Watsa has been an incredible partner. We did the $450 million public offering and a $200 million private placement of Fairfax on top. So, with the growth, EBITDA tripled almost in the period of 6 years on the privatization. Revenues doubled, EBITDA tripled, free cash flow is growing. We wanted to get the balance sheet right. So, we've gotten down now, post-IPO, we're at 0.2 times approximately debt to EBITDA. That gives us a pristine balance sheet with high free cash flow conversion and growth platforms that are winning. And, again, the runways on dietary fiber, protein, and lentils, chickpeas, peas, beans, pasta is a long, long runway. So we believe that Canadian companies need to be public if they're strong and building a champion platform like we are. And we thought the time was right to do that.
Okay, so stock's at about 21 and a quarter. Your IPO is at 23. Clearly, you believe that, as you said, there's an earthquake kind of shift in the way people are eating. How are you going to restore confidence for shareholders?
Well, again, we're on day 4 of trading, and so we're going to take it again a quarter at a time, and we're going to deliver. And we were very clear in the IPO roadshow. We saw over 150 institutions around the world in a very involved marketing of the company. And, we believe strongly that, listen, free cash flow doesn't lie. And low leverage is going to lead us in a modular CapEx strategy where we can keep low CapEx intensity to growing our capacity in pasta and better for you packaged foods, that ultimately free cash flow conversion is really high with low leverage. The company's going to become very valuable. And that's what we're going to focus on. And, it's an unusual IPO. Fairfax sold no shares and subscribed to 200 million more shares. And me as the founder sold no shares. Usually it's the opposite. Sponsors selling at the peak, founders are trying to cash out. In our case, we rolled everything. We're going long term and we're going to deliver.
Well, I was speaking with Murad Al-Khatib, CEO of AGT Foods. Coming up, shares of Gap Incorporated are under pressure today after the retailer missed consensus expectations for same-store sales growth. We'll break that down when we come back. We are watching shares of the Gap today after the retailer reported disappointing results at 2 of its apparel chains. In fact, it's down more than 12.5%. For more on this, we were joined earlier by Bloomberg retail reporter Lily Meyer.
I think the weakness was really in Old Navy, which is Gap's biggest brand, and mostly Athleta, which is Gap's smallest. So Old Navy missed estimates, it's still growing, while Athleta is still slowing down much faster than, or at a higher rate than, analysts expected.
And people were hoping for a turnaround, and there had been signs of recovery at the Gap under the current CEO.
Yeah, and I think the turnaround signs are still there. I mean, this is their 8th consecutive quarter of comparable sales gains, but I think Athleta really continues to be a sore spot for the business. I think the athleisure market is really tight, and Athleta really hasn't been able to break through.
Athleta, it's interesting. I'm just thinking about Lululemon, as you know, has suffered. Is this Athleta specific? I see you quote one analyst as saying their stuff, which is activewear for women mostly, is a bit bland or is perceived as a bit kind of run just middle of the road.
Yeah, that's a great question. I think it's a little bit of both. So I think the athleisure wear market right now is really crowded, and so it's harder than ever to break through. But I think Athleta has some of its own challenges. I think the product really hasn't resonated. There hasn't been a ton of innovation, and so it hasn't really excited shoppers recently.
Yeah, we're looking though at the stock. It's had quite a run upward over the past 2 or 3 years. Now, I haven't had a chance to drill into the Gap numbers, but other retailers, we're looking, wow, Gap has outperformed Lululemon over the past year. But other retailers have said, young people are not spending. And I guess that's an important metric for any apparel retailer, young people getting out there and buying outfits.
Yeah, I mean, I think Gap would probably say they're still seeing young people spend. Richard Dixon, the newish CEO, has been very effective in having a lot of buzzy collaborations and partnerships that I think have really brought in a younger consumer to Gap and brought it back into more of a cultural relevant standpoint.
Oh, that's interesting. Even because, of course, their granddads in some cases wore a Gap, and that's got to be a challenge.
Yeah, I think it has been for the brand over the past several years, but I think they found that using celebrity activation and also partnerships with brands that younger people are loving has been very effective in bringing Gap back into kind of a young shopper's mind.
And he was speaking with Bloomberg's Lily Meyer. Well, market calls coming up next. Today on the show, we have Paul Harris. He is partner and portfolio manager at Harris Douglas Asset Management. He'll be taking your questions on North American and global stocks. Let's take a look at how the markets are doing as we approach midday on Bay Street. They are not doing well. We'll leave it at that almost. You can see the TSX is off by 1.2%. Pretty much every sector is in the red right now. And there is some gainers though, and one of them they want to take note of. We just were talking about Aecon, and it is up right now. It was last time we checked, it was up about. There we go. It's up 10%. And at its highest point since 1991, so more than 30 years, 35 years since it was last at this point. The infrastructure company's fourth quarter adjusted earnings per share beat estimates. And obviously, it's one of the ones that people are actually liking right now. TD Cowen's Michael Tupholme saying we continue to like ARE's positioning and growth outlook. And Maxim Sichev, who we were just talking to, said it was a beat on record backlog and better than expected margins due to de minimis legacy fixed price losses. Now, going the other way quickly is Algonquin Power, and it's plunging now. It's down by about 12%, and that was the most since August of 2 years ago after it cut its 2027 earnings per share guidance due to a higher than expected effective tax rate. Quickly, south of the border, numbers aren't any better there. Look at that. S&P 500, Dow, both off by more than a point. NASDAQ almost off by a point. All of this on energy prices. Oil topped 80 almost at one point today, maybe hovering around there still. Thanks for watching Morning Markets. We'll see you tomorrow.